Hello, everyone, and welcome to Cole's Vault Finance Unlocked, where we tap the knowledge of industry experts to uncover their most valuable insights and strategies. I'm your host, Cole Enerson, and today's episode is one you won't want to miss. We're joined by Collin Baumann, a standout real estate agent based locally here in Utah. Together, we'll explore how real estate agents bring value to the table, cover investment strategies, navigate interest rate trends right now, and reveal why real estate is a powerhouse for investors seeking tax-advantaged growth. Before we jump in, don't forget to hit that subscribe button. Your support helps us share this vault of knowledge with even more listeners. Now, without further ado, let's dial in and nab some knowledge. Collin, we've known each other for a while. Done everything from Spartan races to babysit to podcasts together. So why don't you introduce yourself a little bit? Tell us a little bit about what you do.
Cool. Yes. We got to know each other because we live close together. I'm a real estate agent. I'm married, have 3 kids. There are 3 girls, so I'm a girl dad. So love that. Praying for that boy one day. Can only flip a coin so many times.
Yeah.
But yeah, so have always loved money. So started my career path as a financial advisor. I was going to be a financial advisor. I was going to college studying that. I was going to get my CFP, was working at Fidelity as like a low tier advisor, studying everything I could about money, quickly fell in love with real estate, felt like it was more of an inefficient market than the stock market, which left more opportunity for small investors. And so my wife and I bought a duplex. We kind of decided we wanted to go the real estate route. Had a hard time telling everyone to put their money in the stock market while we were putting our money in real estate.
Fair.
And so then kind of through a roundabout way, ended up landing in real estate as a sales agent. So
nice. Well, and I know that it's going well, so congratulations.
Thanks.
It's interesting because you mentioned financial planning was one of the areas you were going into first because you were interested in money. And I've found that a lot of people don't know what a financial planner is because they could be everything from insurance agent to somebody doing tax planning to somebody that just does investments. Is the real estate world similar? When you say you're an agent, do you feel like people know what that means or that expectations are set properly?
Yeah, I actually hate the title of real estate agent, truth be told. Like, to be known as a realtor, I think realtors are just kind of known to their prospective client as their friends and family. Sure. And everybody knows 4 or 5 of them. And so I hate introducing myself as a real estate agent because then people change how they respond to me. Probably similar to the financial planner.
Oh yeah, I never know what to say.
Yeah.
And it's like, well, how much detail do I give?
No idea. When truly, like, I just want to build relationships with people, and my business for the most part is already built. Like, I'm not, you know what I mean? I feel like in order for me to sell something, I have to truly believe in it.
Yeah. I
feel like with real estate, I can just kind of jump right in, offer people my 2 cents on financial advice. I've kind of taken more of a financial spin on building my business. I feel like a lot of my clientele migrate to me primarily because I have insights, or I'm a high detail guy on markets, and they have questions for me on markets, where it's headed, interest rates, things like that.
That was one of the things that was interesting to me because I've used another real estate agent. It was a good experience. There wasn't anything that was wrong with it. Another friend, to your point, loved the person. It was a good experience. But I was really interested in working with you because of knowing your background with rentals. I was interested in getting some of that information along the way, which has been super helpful for us, for me and my wife, as we've started to rent. How do you think through value add? What are the biggest places where you can add value to people as a realtor?
I feel like anywhere where people make mistakes is where an area where you can add value. That's true for any industry, any business. So similar for financial planning, any area that somebody's going to make a mistake that's going to cost them thousands and thousands of dollars. So if you think about real estate, like, where do people make mistakes? Like, okay, people make huge mistakes on lending. 100%. They make massive mistakes. They refinance when they shouldn't be refinancing to pull cash out, or they are paying way too much in discount points based on their own opinion for the market, or not paying enough and just structuring the whole piece of finance. So that's one area I think that's huge. Is I love that I can get in the weeds on lending and have a perfectly unbiased opinion because I'm not getting paid on lending.
Sure. Yeah.
So that's one area. Another area, ton is for sure value add to a property. So knowing like what actually is going to add value, which depends based on the property, a $1.5 million home, you might need white oak cabinets, or, you might need something that's a little higher level to.
Yeah. If you're going to upgrade a $1.5 million home, probably don't want to skimp on some of the finishes.
Yeah, some of the finishes become more important. Whereas if you're, upgrading a $400,000 townhome, you're probably looking at just throwing in white RTA cabinets, quick assemblies. It varies based on house. And I feel like one of the big areas where people make mistakes is they just make the assumption that any dollar they put into their house, they're going to get out of it.
Yeah. Which I think a lot of people assume, because there's always this endowment bias too of whatever you own, naturally you think it's worth more.
Yeah.
And especially when hey, I put blood, sweat, and tears into this house. If you're a DIYer, or I put 40 to 50 grand into my basement.
Yep.
I expect to get that plus out. So what are some of the renovations, remodels, the things that people do to their homes that you see that add value, and what ones don't add value?
Yeah, I mean, generically, just like without diving too much into like a specific situation, paint, flooring, and kitchen. Like those are kind of those would be your top three. I wouldn't touch, if those are like aren't dialed in, I wouldn't touch anything else.
So those are going to add value. So start there.
Bathrooms can be kind of like an anchor holding your value back, but they're also simultaneously expensive to upgrade.
For sure.
And whereas like kitchens, almost no matter what, if as long as you're not overspending on your budget, if the kitchen's 20, 30 years old, you can almost always get at least $1 for every 75 cents you're throwing into it. Similar thing with paint and flooring. Paint and flooring is actually probably more like you get $1 for every 50 cents you're throwing into it. If it's like, again, this is like, you're not painting over a beautifully painted home. This has got to be like,
sure, yeah.
It's got to be like you're fixing, something that needs to be fixed.
To change the aesthetic so much.
100%.
And that's, I think, as buyers, I think we're all emotional. I know I am, unfortunately. And so when you walk into a place and it feels good, you're so much more likely to act. And so I can totally see where that would add value.
I think too, like the general public actually uses home renovations to justify what they want to do. The investment almost justifies like the expense, if that makes sense. So it's like, hey, I want to put automatic shades in my house, Collin. Like, am I going to, push the value? And people want me to be like, yeah, absolutely. But it's just not. It's just, and so I think helping people be like, okay, this is genuinely a lifestyle expense versus this is actually an investment.
Yeah.
I think is for sure helpful, especially when it comes time to where you're preparing to sell, where you're actually not even going to be enjoying the expense.
No, I think about that all the time. And houses for me are a big lifestyle asset. It's interesting because especially primary residents, we all need somewhere to live.
Yeah.
Right. We can rent, we can own, but it affects your lifestyle, like who your neighbors are, what they want to do to hang out. If you're religious, that's who you're going to see.
Or your kids, who your kids are hanging out with.
Your schools, like there's so much that's going to be based off from your location and the type of people that you're around. And so I see it a lot of times as a lifestyle asset, but there's a lot of people, especially in our area, who will, like rent the basement, for example, and live in the top. What are your thoughts on primary residence as an asset? How does that fit into somebody's progression as they're adding real estate to their wealth?
Yeah, I mean, that's how we got started. Is we bought and moved and bought and moved. We bought a non-conforming duplex and we lived in half.
What does non-conforming mean?
Non-conforming just means it wouldn't fit the current zoning.
Okay. Yeah.
And so it's super popular in our market to own a single family home and rent it out as a duplex.
Sure.
And so you're living in, which can be totally legal while you're living there. And then when you move out, it can kind of like cross some gray areas.
Blurred. Yeah.
It gets a little blurry, but everyone's doing it. I think people should know what they're getting into, whether something is conforming and non-conforming.
Absolutely. That's one of those value adds, right?
100%.
Knowing the zoning.
Well, and that comes down to value. If it's non-conforming, you'll take a hit on value. If it's conforming, you're going to have a better value. We bought a non-conforming duplex and we just bought and moved. Then we moved into a condo. We just kind of have done, people call it the nomad strategy.
Okay.
Where you just buy and move. That's how we accumulated rentals. I 1,000% believe in the nomad strategy. Markets shift. All right. And so in 2018, when we started buying property, you could buy a duplex or a single family home, and you could put 5% down and you could break even on rents.
As far as cash flow.
As far as
so
cash
looking
flow,
at what's going out, what's coming
mortgage
in.
is $1,800.
Break
We're
even.
bringing in $1,950, offset some vacancy, some repairs. Nowadays, that's just not the case. With 7% mortgage rates, values have just skyrocketed in 2021, 2022. They've kind of held, at least in our market. We've seen some contraction in certain like sub markets, but it's just things just don't cash flow. We're when you have a 7% mortgage rate, and our current cap rate in our market is probably closer to somewhere between a 4 and a 5 cap. It doesn't matter. The napkin math will just never pencil out to having you cash flow.
Yeah.
And so people make mistakes when they blur the lines of this is an investment and this is where I'm going to live. If you're needing to save up 20%, I would argue that your home is, I would say it's not necessarily an asset, but you can do certain things that will either turn it into an asset while you're living there. I think generally speaking, most people should not be viewing their home as an asset.
Yeah, and it's all in the definition, right?
Sure.
And one of the thoughts that I come back to is, okay, should I be seeking net worth or should I be seeking cash flow?
Yep.
Because that's very different, and how you measure success in those two realms, very different.
Yep.
And it changes that conversation. So you mentioned several things that I want to hit on. So nomad strategy.
Yeah.
You said you really like it, but that worked really well when interest rates were, say, 3%, but now at 7%, the cash flow becomes much more difficult. You mentioned cap rates. So cap rates meaning net operating income over your market value.
Yep.
So you can kind of think of that as one form of rate of return. How do you work through those numbers with people when they meet with you to see, is this a good idea or not? Because markets are dynamic. So what does that look like?
Personal finance is personal, right? And as a financial advisor, you'd know that. Like, first, you got to talk about somebody's long-term goals. So if somebody's just wanting to build the biggest net worth possible, truth be told, most leverage you can personally stomach and play defense on is probably always going to work to someone's end. And you're going to get more leverage owner occupying and nomading. I'll just speak by example. So I have a client, and they started to do the nomad strategy, and they're young and willing to make the sacrifices with what they want to live. And so they can pretty much look at their nomad purchase truly through investment eyes, because they're willing to live whatever is going to help them push their net worth.
Yeah, they're not looking for stability. They're
100%.
okay to move every couple of years.
They're not factoring in school districts and higher purchase prices. For example, myself, I have 3 daughters. My wife studied interior design. She loves the way things look, which
does a great job. Beautiful house.
Great for the home. Every time I move, we just start pouring money into real estate because we just renovate it, and we start doing projects. We built built-ins and shelving, and we finished our basement, and there's a certain standard of living that we kind of want, and that doesn't pencil out from an ROI standpoint. But there's an element of like knowing who you are. Whereas this other couple, they're in a position where it's like, hey, like, we're just in a grow mode.
Yeah.
Which I say I'm still in a grow mode, but in a different way. There's more factors. I've got kids to worry about. I've got a wife. There's a lifestyle that we're probably no longer willing to sacrifice.
Yeah.
I'm not willing to live in a 2-bed, 1-bath condo or a 3-bed, 2-bath condo anymore because I want to get my kids outdoors as much as possible.
Yeah.
And so, long story short, it would be like, hey, let's talk through your goals. Let's talk through like where you want to be. And then you can go over various strategies that fit people's. And a lot of times the easiest entrance for the majority of people is a nomad, some form of a nomad.
Sure.
Where I would say like while they're living there, probably truly not an asset. You say, but you move, all of a sudden you're not going to keep dumping money into renovations and into doing things from a lifestyle perspective, because now it's just a raw investment. Now it's just a profit and loss statement. And so I do help a lot of people where it's like, hey, we're sitting on this house. We want to move. We had a 2.75 interest rate, a 3% interest rate. And it just makes zero sense to sell this house right now because values are a
Yeah.
little bit compressed, but my interest rate's amazing. It's going to cash flow like crazy. It's very situational.
No, absolutely, absolutely.
But yeah.
Well, and to me, yeah, like you said, it's situational because
Yeah.
what I followed 5 years ago isn't what I follow now.
Yep.
And there's still themes that resonate throughout, but they change a little bit.
Yep.
One of those things that I think about is debt. Obviously, real estate, one of the biggest sources of debt, for me personally and for most people. How do you think about debt when you're looking at a deal? What factors into the decision on how much debt and comfort level with debt?
Yeah.
I'm gonna hit that.
Yeah, for sure. So I would classify myself as a very conservative investor. I have always felt like I can afford to not hit home runs and I can afford to just hit base hits, but I can't afford to like take massive losses. I would say that, with certain people's risk tolerance, that might change. And I think risk tolerance equals like your cash flow statement. I think your cash flow statement.
I was just going to say that because I would say, knowing what I know about you and your finances, I wouldn't say you're conservative, but
Yeah.
I'd say as long as the cash flow works, you're comfortable.
Yeah, I think everyone values and looks at risk differently.
Yeah.
And so to me, there's a couple different statements or ways that I would evaluate my own risk within my own portfolio. The first one, by and large, is your own personal family cash flow statement. Like,
Yeah.
if you are spending every dime that you're making and you are going to go buy a rental property off of a HELOC and you're already not saving money and now you're introducing more debt and you're like barely breaking ends, probably not the best investment because historically rents don't compress a ton, but they actually have compressed a little bit over the last 18 months.
Yeah.
Or you have a nightmare tenant or you have rents compress or something happens and you're forced to sell at an adverse time. That's how you lose in real estate, right? If you have a property and you're cash flowing, $400, $500, $600 a month, say you're up against vacancy, you can always drop the rent. You can sign a 6-month lease, drop the rent it for a lower price. My rule of thumb is 6 months of cash reserves on everything. So I keep 6 months cash reserves on my own personal financial statements. So like what our family needs to live, my savings and emergency fund's gonna have 6 months. Yep. Same thing. My rentals are ran like a business. So all my rentals flow into an account and I have 6 months cash reserves on those rental properties. So crazy things have happened. I could carry that for 6 months.
Do you do a separate account for each rental?
No, I kind of now currently am viewing more my portfolio as like one total portfolio.
Yeah.
Which I think comes into another thing is like, okay, so you have your cash flow statement on your house, you have your cash flow statement on just one single rental, and then you kind of have a cash flow statement on a total portfolio. And so I actually would be more comfortable taking at the current place where I'm at, I'd be more comfortable taking a higher upside on a property.
Yeah.
Even if the cash flow is not the sexiest in the world, just because my cash flow on my portfolio is really, really promising.
Which right now is probably more so the case. If you've been a real estate investor with those low interest rates, you probably got a good foundation of cash flow. Whereas right now, cash flow might be a little tougher to come into because of the high interest rates.
I would say real estate is probably the most inefficient market. However, there are certain levels of efficiencies across like investment properties in the sense that if you're wanting to buy the highest cash flowing asset in our market, it's going to be a piece of junk.
Yeah.
Because no one else wants it. That's why it's trading at a high cash flow. If you want to buy the property that, potentially could have really, really high appreciation, like a $2 million house in Highland that historically has had a higher appreciation than surrounding cities, then your cap rate's gonna be like 2.
Yeah.
And the cash flow metric on it is garbage. People don't always realize this. You'll see some people enter the game, newer people enter the game where they just are so cash flow hungry that they just make stupid decisions. So you throw cash flow off the table. If you don't want to own that thing for 20 years, 25 years, what are we honestly doing? You know what I mean?
Yeah.
If you don't believe in the asset, that would be the equivalent to me.
It's more trading, right? It's more trading than investing. You're 100%. Looking for short term, get in, get out.
Yeah.
And depending on what you're doing for value add or not, that could just be a complete trade in a cyclical industry where interest rates, which we have no control over, unfortunately, could do anything.
It's like, hey, this is really sexy. It's running. But like eventually, reasons cash flowing so heavy is there's probably maybe some deferred maintenance that's going to come up that's going to wipe a lot of that cash flow out. Or maybe there's no appreciation on the table because it's, just in a junky area.
Yeah, that's an interesting point you bring up about factoring in like what maintenance is coming up. Because when I'm looking in my cash flow and I'm figuring out, okay, here's my rent, here's my mortgage,
Yep.
here's what I'm going to put away for maintenance, professional services, if I'm having somebody else do the lawn or whatnot. That's an important thing that, a new build versus a 15-year-old build. Yeah, am I going to have to do carpets or roof or some of those things sooner than I would on a new home? And a lot of people probably don't factor that in.
Yeah, most investors are napkin mathing most of their properties.
Yeah, I agree. Yeah.
And even when you're so trained like that way, like even myself, like if I find something that's just cash flowing like crazy, you're just a little more excited.
Oh, absolutely.
You're more excited about that stream of income, and so people can get emotional in their own investment process. I just would say people would never buy a stock based purely off of cash flow, and they don't. There's a reason Amazon, Apple, they trade at better price to earnings ratios than some other companies.
Yeah. No, absolutely. Like in my day job, right? If you're looking for like as an investor, you might be paying for 15 years of forward earnings. You might be paying 30 for forward earnings, and the reliability of those cash flows, prospects, pipeline, competitive advantages. There's a lot that factors into it. And that's what I liked, what you said about real estate being inefficient. You don't look at Zillow every day to see what's the price of your home, right? It's a market where you're getting appraisals, which is somewhat subjective.
100%.
I mean, I know that I've had people say like, well, hey, what do you need the appraisal to come back at? They're willing to fudge, 10 to 20 grand either way to get you the numbers you need. And so it's less efficient in that way because there's not price discovery by the second like there is in the stock market.
There are massive advantages with real estate that it's a tangible asset and things like that.
Yeah.
But for whatever reason, like people just don't weigh, because people are so dialed in on cash flow, they just don't look at the whole picture. They don't look at, this is a townhome where you've got an HOA that could potentially rise. What's the state of the HOA? This is really a single family home where we might have to do a roof. What's the actual cost of a roof? How do we expense that in? And your general investor really is genuinely just going to run, they'll just have their set percentages. Maybe they sway it a little bit. Maybe it's like, hey, it's 20 years old. We're going to budget 7% for repairs, 8% for repairs.
Yeah.
Like they might do a little bit this during due diligence, but they're not actually like, okay, we got a new roof, we got new windows, we've got, what is the other deferred maintenance? What's the cost of that? What, and walking that back in.
A lot of it's unknown.
Yeah.
Right. You can't know all of that. There's a lot of people, especially in our market, young people especially, who are interested in getting in the game. I've had some people ask me about HELOCs, and they've said, hey, I'm seeing some friends or family members pull out equity from their home through a home equity line of credit from the bank, essentially taking debt on the equity that they have in their home, and then they're going out and purchasing either a second home or an investment property. What are your thoughts on that? And then just maybe other ways to access equity within your home as well.
One of the huge advantages of real estate is the way it's financed. And if you do it right and do it strategically, it can be the most tax efficient investment across the board, which I love.
It's kind of the cheat code.
Absolutely.
I mean, every CPA I know loves real estate. Vast majority, if not everybody that I know that has a high net worth, real estate is at least a slice of their pie.
Yep.
Right.
Yep. And so, and HELOCs and cash out refinances and all that, I feel like play a huge role. And this is what I would point out to most people is like, they're not a tax event. One of the biggest advantages with real estate is that you can time when you pull a bunch of cash out and then go redeploy all that capital, which is, I feel like, one of the best strategies. When I'm looking at an asset, I want to own that asset for 20, 25, 30 years. Mm-hmm. And I'm looking at it with very long-term eyes. And the biggest advantage is that, in 10 years or 12 years, when your internal rate of return starts to peak and you're looking at markets and it's maybe a promising time to pull a bunch of cash out, then you can go redeploy that capital, re-leverage this asset and properly, like that begins to be the more like enticing process of this story.
Yeah.
Here's my general advice on people: HELOCs, cash out refinances, things like that. I love the HELOC on a very short-term basis.
Yeah, it's a high interest rate. And it's high interest rate,
which is tough. Which that's a short-term loan. If I'm going to pull it out, it's because, hey, I have an opportunity. I'm going to seize this opportunity. I'm buying either at a discount, I'm putting myself in a better situation, cash flow-wise, or whatever that looks like. There's an opportunity. I want to snag it. And this is access to short-term money, and I can wipe this out in a couple of years. I don't love, like, your general HELOC has a 10-year interest-only repayment and a 10-year repayment plan, so it can be amortized over 20 years. I absolutely am not a fan of that. I feel like we don't know where rates are headed, and if the last couple of years have, like, spoken to that, no idea.
So there's an index called the MOVE index. So if you're familiar with the stock market, the VIX, essentially, uncertainty. So it's going to spike when there's a lot of uncertainty or markets are moving down. It's a MOVE index for fixed income or for rates. And man, it's been a ride.
Volatile.
The past year and a half. It's been a real ride.
And 2 years ago, everyone was saying rates are coming down, rates are coming down, rates are coming down. We're waiting for this push. You can get caught up in that frenzy of like rates are coming down, rates are coming down. But when you honestly look at the fundamentals, the yield curve is inverted. Short-term rates are yielding more than long-term rates. Mortgage rates are a really long-term asset. Like, when that all normalizes, are we really going to see fours? Are we really going to see threes ever again? We probably shouldn't if we stay fundamentally sound. Now, the government can mess that. They're going to
do what they're going to do. Yeah.
100%. But, like, you don't base your decisions off that.
Forecasters are terrible. Even the Federal Reserve. I mean, I can pull up chart after chart. Here's their projected, path of interest rates over the next year. And it's not always very accurate. Frankly, it's normally not. And we come from this background of low interest rates. And there's this thought in the market that there's this bias to pull them back down. We've had a really interesting maybe 3 to 6 months because they've started their rate cut cycle, right? So people are waiting and waiting. They're starting to get them. Exactly. And mortgage rates have popped up. The reasoning behind that is that mortgage rates are a little bit more tied to like intermediate to long-term interest rates, right? 30-year mortgage, 15-year mortgage. The Fed, the interest rates they're setting is overnight borrowing, very short term, 1 day to 1 month. The long-term rates actually tie a lot more into inflation and economic growth. So that's been a big disconnect I've been seeing. You've been seeing that with clients as well?
Yeah, for sure. Everyone got so addicted to let's just wait for the Fed's meeting. Fed's meeting is going to dictate this. Let's look at the Fed's meeting. And the Fed dropped rates. The Fed dropped rates, which means mortgage rates are coming down, which means we should be buying. And I think it almost trained, like the way that lenders were watching it, almost trained buyers to watch it to where, like, when we'd see these little blips and then we'd see a frenzy of buying, and all this built up demand is just like happening in droves, and it just would start. It's like red light, green light, in all honesty. I think we got so addicted to interest rates and watching the Fed's rate that we failed to like really zoom out. We're not tied to the Fed rate, and the yield curve is still inverted, and this still needs to normalize, and the 10-year still needs to spike. We need to see more of a spread between the Fed rate and the 10-year, which currently I think is like 30 basis points.
I'd have to look at the numbers. I know we've crossed the inversion.
We just barely crossed the inversion.
We're normalized, but it's fairly flat.
Whereas usually it's closer to like, I think right now we're at like 30 basis point spread, whereas usually we're like 100 to 150.
So 30 basis points for the audience, 0.3%. Right? And so 100 basis points would be equal to 1%.
1%. And then 150, 1.5, and so forth. Like we would expect that spread between the 10-year Treasury, which mortgage rates historically follow. So usually there's a spread between the Fed rate to the 10-year, and then there's also a spread between the 10-year, and it's never really normal, but there are some historical averages that you can do some predictions off of. But anyways, mortgage rates, we might see them kind of stay put. We might see them drop a touch. I do think the spread between the 10-year and the mortgage rates have a little bit of movement to compress. Like there's a little bit.
Spreads are pretty wide. I agree with you. I think the 10-year is about where it should be. Doesn't mean that the Fed won't cut a little bit more. I think we get maybe one cut this year, to be honest, in 2025. But interesting dynamic in the mortgage market. So the Federal Reserve, move interest rates. Another thing that they were doing recently is they were buying in the secondary markets. They were buying mortgages. And so they've stopped doing that. When you have your largest buyer step out of a market, what happens to the spread? It shoots up. So that's what we've seen as the 10-year has risen. And then you've also seen spreads expand as well. That's difficult, and that spread, I agree. I think there's a little room to compress, but I don't know that we're ever going to get back to the spread levels of 2020, 2021, where the Fed was just, they were driving interest rates down, the base rate, and and, buying up the secondary market.
Your average real estate investor, I think they need to watch some of this stuff. I don't think they need to be as in the weeds as I am on. They need to get a couple opinions. I tell all my clients, you need to have your own opinion on the market.
Yeah.
Like, where do you think rent is growing? You got to believe in your asset. If you're investing in real estate, a lot of the reason you're doing it is it's a hard asset. You can watch it, you can feel it, you can touch it. And there's a little bit more comfortability with that.
Yeah.
And I'd have at least an opinion on where you think values are headed, where you think mortgage rates are headed.
Be educated.
Yeah, 100%. There's a growing popularity for let's go out of state. Let's, go where it makes sense and live where you want to live, kind of a thing.
Yeah.
We see a ton of investors here in Utah where it's like, hey, I don't want to buy it at 4 or 5 cap. I want to buy it at an 8 cap. And so they run off to Ohio. They run off to,
gotta go to a different market.
There's no problems with that. Like, there's a millionaire in every corner. There's a millionaire that's buying out of state. Yeah. There's a millionaire that's buying in state. The math and the decision making should not be off of just straight cash flow, which is how most investors are making that decision. Yeah. Interest rates are the single greatest lever that predicts affordability. It's the biggest piece of your mortgage, and that interest rate is the biggest predictor of affordability. And affordability is the biggest lever that predicts price growth. Perfect example is look at the last 5 years. 2020 happened, mortgage rates hit 3%, and real estate becomes the most affordable it's ever been. What happens in our market? We had back-to-back years of 25% appreciation.
Yeah, so money flows in. Yeah. People can't get enough.
Since 2020, mortgage rates spiked, and now things get really unaffordable. Now we've seen very little price growth. We've seen some areas contract. And what real estate's really experiencing right now is this slow, slog, because we're not seeing a flood of inventory. People are sticking in their homes. They don't want to sell because they've got a 3% mortgage rate. Even those that are moving are holding their homes as rentals. And that inventory is also not coming to market. Really, all of our inventory is coming from new construction in our market. We've held on prices, but we haven't grown. For those that are going to out-of-state markets, here's what I would say is, again, affordability is the biggest predictor of price growth. So many people love Texas. Well, guess what? Texas doesn't have income tax. They have property taxes. You don't see massive waves of appreciation in Texas. You just don't. They sell at a really good cap rate. Prices are really low. But the reason you don't see the price growth is because property taxes are so high because it replaces their income tax. Whereas here in Utah, we do see price growth when things get affordable. We see 5, 10. If you go back to the 80s, we've had 5% year-over-year appreciation from then to now. That's factoring in 08, factoring in 2001. Sure. The reason being is because we're the 6th lowest in property taxes. So that our insurance is super, super cheap compared to others. We're not Florida. We're not California.
Which is generally a state-regulated industry, right? Yep. And that's important to understand is that a lot of insurance agencies, the way they can increase prices is somewhat dictated by approval by the state.
So if you're looking at a market and you're like, hey, where should I go invest? You're going to want somewhere where it's landlord-friendly because of exactly what you're saying. Because that's a state-regulated market, and your property insurance is a big piece of that equation of your profitability. Not just cash flow, but your upward movement. I would factor in landlord-friendly state, low property taxes, low insurance rates. I want to know who's living in the homes. If everybody is renting, if things are 80% renter occupied, what genuinely is your price growth? Because everybody buying those properties are investors. And I'm going to tell you, an investor does not want to pay what somebody that's putting 3% down that loves the home and is in love with it.
They're not willing to pay a premium because it's next to the good school or because they love the view.
Exactly. They're not willing to pay that premium. So if you're 80% owned by investors, you're not going to see the price growth at some places that is 40% owned.
That's going to be a more efficient market.
100%. I still love Utah. We're trading at really low cap rates, but this is where I'm buying. It's not going to make a ton of sense on a napkin math cash flow market.
Hopefully we'll have a CPA on to talk through some of the tax advantages, which factor in a huge degree. I did want to just hit on 2 other things before we wrap up. The first is the exclusion for primary residences when you sell, and then 1031 exchanges. Do you want to maybe just hit on what those are and how those work?
Yeah, one of the huge advantages of owner-occupying real estate is the exclusion of capital gains tax. If you've lived in this unit or lived in this home for any 2 of the last 5 years, then you qualify for an exclusion, which for a single person is going to be $250,000 of capital gains. And for a married person, it's going to be $500,000 of capital gains.
Yeah. Let's say that you buy a house for $500,000. A couple of years past, it's been favorable. Your house is now going to sell for $800,000. So it's not that whole $800,000 you have to worry about tax on. It's the difference between what you paid, your basis, that $500, and the market value at $800. So you've got $300,000 in there. And so if you're single, like you were saying, you wouldn't have to worry about the first $250. You'd pay capital gains tax on the 50%, which is different than income tax. So 0, 15, 20%, depending on your income. And then if you're married, that whole $300,000 was tax free.
If somebody bought in 2020 and they lived in it 2020, 2021, and then they moved and rented it out, which is a lot of people.
Yeah, tons.
Now all of a sudden, say they rent it out for 2 or 3 years and they've got $200,000 of capital gains or $150,000 of capital gains. It 1,000% merits the conversation. It merits the conversation of let's sell, let's take our exclusion, take all this gain, and then just repark it in. If you breach that gap, now all of a sudden you're going to have a capital gains tax of X number of dollars. If you're going from, hey, I've got $200,000 of growth tax free and my income would merit a 20% tax on that, that's 40 grand.
That's one of the conversations I'm having right now. I think we're going to end up holding on to our property. But I know that I have 2 more years, right? Because I've moved from my property for about a year. So if I'm going to be 2 years owner occupied within that 5 years, I have 2 more years to decide.
Real estate can be depreciated. So it's one of the only assets that appreciates that can be depreciated against, which typically would offset against your passive because it's seen as a passive investment.
Yep.
And that would offset against your passive income. Again, not a CPA.
Sure, unless you're a real estate pro, there's a lot more there.
Yeah.
We'll hit that on a different podcast.
For sure. One thing to take into account, I have a client right now who's bought a duplex. He bought it in 2019. He's lived in it. He bought it for mid 4s. It's now worth low 7s. I mean, that's a massive amount of capital gain tax, and he's still qualifying for that exclusion. He's now selling. Like, I would say more often than not, my advice to people would be to hold it.
Well, the transaction could be expensive, right? By the time you pay title agencies,
buyer's agent, seller's agent,
agents, like
there's so many people involved.
That can add up, and if you're just high turnover.
One thing to think about is they moved and they thought they were just going to hold this thing forever, so they started to depreciate it.
Yep. So depreciation, meaning the IRS, Internal Revenue Service, views that your asset or your house has a useful life. Yep. They've deemed that to be, I think it's 27 and a half years. Anyway, so you can take, whatever percentage that is, roughly, we'll call it roughly 3% of that value as a passive expense each year, even though nothing's changed.
So they bought it, they have the exclusion, they started depreciating, and now they're selling it. They still have the exclusion, but because they depreciate it, now they have some recapture.
Yep.
And so, needless to say,
so they're going to have to recapture that expense as income when they sell. So recapture is at 25%. Yep. So if you're paying 12% on your income tax, and you were getting that benefit along the way of an expense at 12%, now you're going to pay it at 25%. So that gets tricky. Once you get into 22, 24, 32, once your tax bracket goes up, that recapture isn't as bad. But that's something for people to consider that are paying an effective rate that's lower.
Worth the conversation. If you have had this massive equity run on a property that you bought and are now renting out, worth a conversation of like, hey, maybe let's hold off on depreciating this asset. Maybe let's not depreciate it for the next 2-3 years because let's see where we lie within our exclusion. Because, like you said, recapture is at 25%, whereas my income tax might only be at 12% on those dollars. There's a lot of moving parts, and you got to work with somebody who knows what they're talking about. Your average real estate agent in our market is going to work with this client, and they're like, yeah, I can sell that for X. They're never going to have a conversation on the exclusion.
Yeah.
They're not going to talk about, did you depreciate this property? They're not going to loop in their CPA because they don't see the whole picture. When you want to invest in real estate, there's a massive amount of planning. There's way more moving parts. And like capitalizing on some of these moving parts is super, super important. To come back to 1031 exchange.
1031 exchange is something offered to investors in real estate where you can essentially exchange. There's a certain process you have to follow that we can hit another day.
Yep.
You can essentially, as long as you find another property and you meet the time requirement, you can defer your tax gain, right?
Yeah, so like for like is the big thing. So if you say you bought a single family home, you bought it, or let's just come back to the duplex since we're on that subject. So they bought it for 460. They started depreciating it on a 27.5 year schedule. That's probably like 13, 14 grand a year. They start depreciating that basis. Say they continue to hold it, and they eventually depreciate it down to where the house is on the books. The CPA basically says the house is now worth 100,000 because we've depreciated 350,000, whatever that dollar amount is. Now all of a sudden, if you sell that asset, you're going to recapture a massive amount of
that'd be a huge hit.
Especially if you're in a high earner year. Terrible time. And so now all of a sudden, if you could sell that asset and trade it like for like, put all those dollars into another asset of equal or greater value, and you defer paying that capital gains tax. I think that wealth planning really is tax planning. It's
most people's biggest expense.
It's your largest expense.
You're not factoring in your boot on your 1031 exchange or whatever it is, like that can come back.
If you can lift your income 20%, everyone's going to do it. I think it's really, really fun. It's a fun thing to plan around. It's a fun thing to learn. And it's important to know that it changes. There's no silver bullet. Sometimes Nomad's super, super popular and everyone should do it. And then maybe sometimes it, depending on your phase of life, maybe it makes a little less sense.
I'm a big believer in, take a diversified approach, be very balanced. But when there's a fat pitch, you got to swing.
Yeah.
And you got to be ready to take that swing, which can be difficult. I'm a big believer in real estate. Obviously, it's part of my portfolio and what I hope to keep going. Thanks for your time, man. Appreciate it.
Super
and
fun.
If the audience wants to find you, how do they get a hold of you?
Sure. I'm like an anti-social media.
Yeah, you are.
I don't get on Instagram. I don't get on Facebook. Literally, they can call me, text me. My number is 801-879-5983. I'm much more comfortable with somebody texting me than somebody living in my DMs.
Yeah, no, that's fair. That's fair. Well, thanks again, man. Appreciate it.
Yeah.
And hopefully we'll be able to do this again.